Two companies, same product, used cars. One just lost $11 billion. CEO fired 6 weeks ago. Stock crashed from $155 to $46. Layoffs every quarter. The other? Everyone said they were bankrupt. Stock hit $355. Dead company walking. Then it went to $480. 11,000% return. 2 years. Same market, same customers, same economy. One dying, one thriving. And here's what should terrify you. The company losing had every advantage. Bigger, richer, more trusted. 200 stores, 25,000 employees. They still lost. What killed them is probably hiding in your business right now. Stay with me, because you need to understand this. I'm going to be real with you. I've been watching CarMax commit suicide for 3 years while everyone celebrated their earnings reports. I tried warning people, made videos, wrote threads, watched them ignore every red flag. This hurts to watch because CarMax genuinely revolutionized an industry. They treated customers like humans when everyone else treated them like victims. And then they just stopped adapting. Here's where we are right now, January 28th, 2026. CarMax is trading at $46.96. All-time high was $154.85 in November 2021. They're down 68% from peak. Carvana closed yesterday over $400, the company that was definitely going bankrupt. Let that sink in. I'm going to tell you exactly how we got here, and more importantly, what you learned from it. Because this matters even if you never buy a used car. This is about how companies die when they refuse to see reality. CarMax wasn't always a disaster. They invented modern used car buying. 1993. Circuit City executives asked, "What if we stopped lying to customers?" Revolutionary, right? Back then, buying used cars meant sleazy salespeople, plaid jackets, and the "let me talk to my manager" scam. Information asymmetry. Dealers knew everything. You knew nothing. They exploited that gap. CarMax said no. Fixed prices, no haggling. 125-point inspection on every car. Free history reports. 30-day money-back guarantee. It worked, slowly. They opened just 7 stores in 4 years, getting the model right before scaling. By 2000, they did $2 billion in revenue, $1 million in profit. Razor thin, but proven. Fast forward to 2021, CarMax looked unstoppable. 200 stores, 41 states, $31 billion in revenue, $1.2 billion profit, selling 1 out of every 25 used cars in America. Stock at $155. Fortune's best companies to work for 21 years straight. Perfect, right? No, the world was changing underneath them, and they either didn't notice or didn't care. Millennials became the biggest car buying demographic. They do 14 hours of online research before visiting dealerships. They hate haggling. Perfect for CarMax so far. But millennials grew up with Amazon. They don't just want to avoid haggling, they don't want to visit dealerships at all. Complete the transaction online. Car delivered. Done. 2013, Carvana launched with exactly that model. No stores, no salespeople. Buy online. Car shows up. CarMax saw this. They're not idiots. 2015, they launched omnichannel. Fatal mistake. To CarMax, omnichannel meant research online, buy in store. To customers, opposite of what they wanted. This is the innovator's dilemma live. CarMax had 200 expensive stores on prime real estate, 25,000 employees trained for in-person sales. Their entire competitive advantage was built on foot traffic. Going fully online meant admitting that infrastructure was now a liability. Massive layoffs, store closures. Admitting their moat became a prison, so they compromised. In business, when disruption comes, compromise is slow death. Then Gen Z arrived. 43% want to buy exclusively online. No dealership. Period. Won't do it. CarMax was 2 generations behind. COVID hit. This gets interesting. Pandemic arrives. Stimulus checks everywhere. People stuck home with money. Chip shortage destroys new car production. Automakers lose $250 billion in sales in 2021 because they can't build cars. Used car prices explode. 40% increases. 1-year-old used cars selling for more than new ones at sticker, if you could find new ones. CarMax prints money. Sales jump 68% to $31 billion. Stock hits all-time high. Analysts call them visionary. Smart leadership would say, this is temporary, a sugar rush. Use this windfall to rebuild for digital. They didn't. Spent $400 million buying Edmunds, thinking that solved their digital problem. Kept buying inventory at market peak. My Subaru? Carvana offered $30,000. Worth $12 now. Insane. They partied while the sun was shining instead of fixing the roof. 2022 arrives. Fed jacks rates fighting inflation. Car loan rates nearly double. 8.5% to almost 12%. Subprime borrowers, 15% or higher. Math time. Average new car payment, $730 a month. Used, $560. In 2021, under 7% of borrowers paid over $1,000 monthly. By 2023, over 20%. Subprime delinquencies hit 3-decade highs, 7% delinquent. By 2024, 1.78 million vehicles repossessed, worst since 2008. February 2025, 1 in 3 loan applicants rejected. CarMax's beautiful flywheel reversed. Fewer buyers, fewer loans, fewer sales, less inventory turnover, but still 200 stores and 25,000 employees to pay monthly. Carvana? No baggage. Cars now last 12 plus years. All-time high, more reliable than ever. New car prices insane, 70, 80,000 for entry trucks. People keep what they have. Right when CarMax needs 7 to 10-year-old trade-ins, supplies shrinking. Then EVs 20 to 25% of sales in some markets. Younger buyers love them. Future's clearly electric. CarMax, built entirely on combustion engines, doesn't have EV battery testing until June 2025. When they add it, they outsource because they don't know how. Don't know how to price EVs. Don't know how to sell them. Tesla cuts prices 40% over 2 years, and CarMax sits there with traditional models wondering why nothing works. Carvana's moving at internet speed. 2022. Everyone thinks Carvana's dead. Stock hits 355. Massive debt. Inventory problems. Short sellers celebrating. Bankruptcy lawyers on speed dial. But Carvana had what CarMax didn't. Flexibility. No stores to protect. No massive real estate. No 25,000 employees doing things the same way for decades. Things got bad. They moved fast and hard. Cut $1.1 billion in expenses. Laid off 4,000 people. Restructured $1.3 billion in debt. Painful? Absolutely. Necessary? Yes. Mid-2023, first profit ever. Stock? 355 to over 400 in under 3 years. 11,000% returns. Carvana sells cars averaging 24,000. CarMax? 26,000. Price matters when everyone's struggling with payments. Carvana sales up 60% year over year. CarMax down 7. Despite CarMax having 4 times Carvana's revenue, the market values Carvana higher. The market's spoken. It knows who's winning. Carvana got added to the S&P 500 in December 2025. The bankrupt company's now S&P 500. 6 weeks ago, December 1st, 2025, CarMax fired their CEO, Bill Nash, with the company since 1997. Almost 30 years, worked up from auction manager to CEO. Good guy by all accounts, fired. Official announcement, stepping down. But when they announce an interim CEO the same day, they release terrible preliminary earnings. And that interim's a board member brought in to strengthen the business during this transitional period? We know what that means. Stock fell 24% that day. 24%, single day. Third quarter outlook was disaster. Used unit sales down 8 to 12%. Comparable stores, so can't blame locations. Today, CarMax stock, $46. Down 53% in 2025 alone. Down 68% from all-time high. Lost over $11 billion in market value. Layoffs every few months. 400 in October 2024. 350 more in 2025. More coming. Cut their famous 30-day guarantee to 10 days. The thing that made them special? Cutting it to save money. Let me tell you what you actually need to learn. I didn't make this video just to entertain you. These lessons apply to your business, career, investments, everything. CarMax's 200 stores were their moat, then their prison. Those million-dollar stores costing thousands monthly to operate went from advantage to liability when customers stopped wanting to visit. If you're coasting on an advantage you built 5 or 10 years ago, wake up. The world doesn't care what worked before. It cares what you do for customers right now. CarMax saw the online trend, acknowledged it, invested in it with omnichannel. But they compromised. Tried protecting stores while going digital. Can't do both. When disruption comes, burn the boats. Go all in on the new model even if it cannibalizes your existing business. Because if you don't, someone else will, and they won't care about protecting your old model. Carvana didn't compromise. All in online from day one. That's why they won. 2021 was CarMax's best year ever. Record everything. Underneath, business model rotting, customers shifting online, younger demos wanting zero in-person contact, EV acceleration, car longevity increasing, every trend against them. COVID boom masked it all. Revenue explosion let leadership ignore reality. Fix structural problems when business is booming and you have cash, not during crisis. CarMax had billions and years to rebuild. They chose not to. CarMax built a model perfect for Gen X. No haggle, transparent, in-person service. Exactly what Gen X wanted. They assumed next generations wanted the same. Millennials wanted same benefits, but online. Gen Z wants exclusively online. Your customer isn't static. What delighted them 5 years ago frustrates them today. Evolve with them, or someone else will. 400 million for Edmunds, billions in real estate. Decades of training and culture, sunk costs, money already spent. But CarMax let past investments dictate future strategy. Question isn't, how much did we invest? It's, what's the best decision now given what we know? Carvana had no stores to protect. When they needed cuts, they did it. 4,000 jobs gone. Brutal but necessary. CarMax couldn't make that call. Protected the past instead of building the future. Here we are. January 28th, 2026. CarMax, $46 per share, down 68%, 11 billion destroyed. CEO fired. Layoffs in waves, cutting warranties. Carvana, over $400, up 11,000% from near death. S&P 500, sales growing 60% while CarMax shrinks. Same market, same products, same economy. Completely different outcomes. The difference? Courage. Courage to disrupt yourself before someone else does. Courage to make painful decisions when you have time and resources. Courage to admit what got you here won't get you there. CarMax had every advantage: size, brand, trust, capital, experience. What they didn't have? Willingness to burn their old model and rebuild for the future. They chose preservation over transformation. Now they're fighting for survival. This isn't just about used cars. This is about what happens when fear of change overcomes commitment to customers. This is what happens when you protect your business model instead of serving the market. If you're thinking, that could never happen to me, you're wrong. It's happening to someone in your industry right now, maybe to you and you haven't noticed. The question, are you CarMax or Carvana? Protecting yesterday or building tomorrow? That's it. If this helped you see something differently, subscribe. I analyze business strategy and corporate failures weekly. Comment. What's the CarMax in your industry? Who's the dominant player refusing to adapt? I read every comment. Thanks for watching. Stay sharp. In business, standing still is moving backwards.